The S&P opened the day about 60 basis point higher, but that didn't really last. In fact, the market ended up giving back all the gains and finishing down about 8 basis points on the day. The interesting thing that's kind of developing here at this point is that we're really struggling at this point to really push past the 61.8% retracement level. In fact, you can see that we got up to the 78.6 level and then we gave it all back and basically closed right around that 61.8 level. So when I kind of see these types of things, I begin to think that, maybe there's something going on here in terms of a trend change. It's not unusual for the market to sometimes retrace a change in trend, 61.8 or 78.6. But again, you really need some form of confirmation before you can get too bullish or too bearish. And in that case, to get really sort of, confirmation on it from a bearish angle is that you really need to see the market kind of just drop tomorrow and really over the next couple of days take out this 6,200 support level. There's really, that would probably give us the best indication yet that this is some sort of turning point for the S&P. And the reason why I think it's a turning point is mostly because of what we were talking about earlier last week with this bearish engulfing candle. We've seen these bearish engulfing candles on the weekly charts fairly often, and notice it also came on some decent volume. And historically, when we've seen them, we've had some decent sized pullbacks in the market. I mean, at this point, the S&P is up a little bit this week, about 1.6%, but we haven't really done anything to invalidate the candle either. So at this point, we just have to kind of wait and see how the week closes out regarding this. Obviously, if for some reason the market rallies in a big way tomorrow and we're able to close above 6,400, then the bearish engulfing candle, at least as of right now, is no longer working. And we'll just have to, reevaluate things. The 6,400 level acts as an invalidation of the bearish standpoint, while a break of 6,200 would validate the bearish view. So that's how I would kind of think about things from a very simplistic standpoint at this point, without really trying to make more out of it than what it needs to be. But generally speaking, given that we're really struggling to mount any sort of move, it kind of gives you a sense that this isn't really a big impulsive move higher. This is more of a retracement, more backing and filling, just not really anything developing on what I would consider to be a really constructive basis. And when you look at the RSP, which is the equal weight, you can see it's actually had a bit of more of a downtrend to it, which really just goes to show you, I think, that the market right now is again being driven by just the sort of handful of mega cap names that has really been in charge for a really long time. You can see that downtrend a lot more clear there. When you overlay the SPY on it, you can really see that divergence as well. Another way that I like to look at these things is just by looking at what's happening on the breadth side of things. I don't really focus and talk about breadth very much because these numbers tend to come in later than in the day, and breadth is so difficult you can't really predict which way breadth is going to go. And we obviously have lots of noise in the data, so it makes it a little more challenging. But you can see the last 2 days we've had negative breadth. And when you look at the New York McClellan oscillator, which is one of the indicators I like to use, you can see that we have turned negative. We're down. We turned negative already. We haven't gotten really above that zero bound now probably since mid-July. And when we look at the summation index, you can also see that this has turned lower. I tend to watch very closely the 500 level, and you can see we're down to 548. So we really need to see continued downward breadth the next couple of days to push this below 500. I think if we were to see this go below 500, I think it would tell us a lot about where we are in this market overall. I think it would give us a good sense that maybe the market has finally exhausted itself, and that we could be in for a bit of a downturn. But again, we need to continue to see some breadth weakening. And, when you think about the advancers versus decliners, I mean, it's also a good way to think about forms of liquidity, because obviously the market, has lots of different moving parts. And so when liquidity starts to get tight, you can kind of make an argument that some parts of the market start to feel it a little bit before others, and sometimes those smaller cap tend to underperform. And you can certainly see that the IWM hasn't really performed nearly as well. I mean, it made a really strong comeback, but it just wasn't able to get above this 225 to 226 area. One of the reasons why I would think we're likely to see this happen is because we're obviously in the middle of a TGA refill. So last Friday we got up to around 500 billion on the TGA, and we had refilled a really large amount. And then we saw on Monday a big decline in the TGA, nearly $100 billion, 120 billion. And now this week we've been really just building that back up again. Today was a big settlement date as well from Treasury bills. And so I would think that the TGA probably rises again when we get tomorrow's data, when we get the data for today, tomorrow. Remember, the TGA data is always a day behind. And so what we saw basically was a very minimal change in the reserve balances this week because of this big decline in the TGA earlier in the week, which is just something that I didn't see happening. Now, next week, we're going to get 3 more Treasury settlement dates, and that should continue to further boost the TGA. Obviously, TGA changes on a daily basis given whatever the inflows and outflows are and the need of the U.S. government to fund itself. So it's not exactly, I mean, there are people who predict it for a living. It's not something that I do. I just try to look at the settlement dates and try to understand and know when those settlement dates are coming, and I look for the dates that I expect the TGA to rise and not rise. And so there will be 3 days next week where it will rise. And that should, again, as this number begins to rise, we should really see reserve balances coming back down again as the weeks go on, because we still have about $400 billion to the TGA to get to that $850 billion level, which was equivalent to where we were back in February. And so when we think about liquidity too, we can think about it in a lot of different ways, but another way is to look at the repo rate and the and which way that's trending. And generally speaking, when the repo rate, the overnight repo rate, is rising, that's an indication of liquidity being a little tighter in the overnight funding market, and that generally leads to the SOFR moving higher as well, the secured overnight financing rate. And so with the TGA refilling, my general thought process is that we're going to continue to see liquidity come out of the market, and likely continue to see, probably for a little bit longer, separation between some of the smaller cap and equal weight names, and eventually for that to catch up to the broader indices. So I think generally speaking, going forward, we just want to continue to focus on liquidity components in the market. And the other thing that I think is worth pointing out that I found really interesting today when I was doing some work was really the spread between Italian and German rates. And what's interesting here is that the German 10-year minus the Italian 10-year minus the German 10-year has really fallen to extremely low levels, 81 basis points. And so if you're wondering, why is it that, credit spreads are so tight? Well, I mean, this could be one of the reasons why, right? I mean, there's clearly a correlation, although not a great one because it doesn't work all the time, between, high yield credit spreads and in the U.S. and this Italian-German spread on the 10-year. So right now we can clearly see there's a little bit of a deviation, of a divergence forming between the two. But I think that overall this is a very good risk gauge, and it's a good risk indicator in terms of where the global sentiment is when it comes to this. Now, obviously, there's things going on in the world that could be changing that's causing the spread to change, such as Germany spending more on infrastructure and defense and issuing more boons. And that could really be the reason why you're seeing this spread swap, or why you're seeing this spread sort of change, and why you're seeing the spread narrow, which is potentially the completely wrong reason why spreads in the U.S. should be narrowing, why high yield credit spreads should be narrowing, right? I mean, there would be a fundamental reason for spreads in Europe to potentially narrow like this, and for German rates to potentially rise and Italian rates to basically stay unchanged. In fact, when you look at a German Bund and you look at an Italian 10-year, I mean, and you put them basically on the same, well, first of all, even if you don't put them on the same chart, it becomes abundantly clear that there's a big separation occurring between the two, with the Italian 10-year yield obviously heading lower, while the German 10-year yield is clearly in a period of heading higher. And so when you even put them on the same scale, you can still see that sort of convergence that's taking place. And again, this could be because, you're seeing German rates really kind of rising towards the upper end of the range, while Italian rates are actually moving down towards the lower end of the range. And, again, I'm not an expert in European politics, so I couldn't exactly fill you in on all the details. But I would think that there's something obviously going on, given that Germany is likely going to be issuing a lot more debt in the future, and that could be the driving rate. So I would keep an eye on this spread and just see what kind of happens with it. If it continues to move lower, it might be sending us this mixed message about where risk appetite is. It could be even sending the market a false message about where risk appetite is, because there are things actually changing in Europe that are causing the spreads to change, as opposed to just people taking more risk here in the U.S. And I would just, like I said, I would just keep an eye on the spread, because obviously if this spread begins to widen for some reason, that could cause, these other spreads in other parts of the world to begin, these other spreads here in the U.S. to begin to widen. I mean, even when you look at, corporate spreads, it's a similar type of picture. So just something to keep an eye on to give you a sense of risk appetite in the marketplace. Anyway, hope you have a great night, and please remember to subscribe to my channel, like this video, share with your friends, and we'll see you again soon.